Well, we're here. We have a riveting panel here to talk about Bitcoin yield and opportunities beyond what you think of the yield today. I want to start off with our guests doing a brief introduction on themselves, going around the horn, and then we're going to dive into the questions, and finally some questions from the audience as well. Please, Vadim.
Hi, everyone. My name is Vadim Khramov. I'm the founder and CEO of Edge Capital. Quick background on me, 15 years in TradFi between IMF, Bank of America, US hedge funds. Switched to crypto 5 years ago. Now we're on about $500 million in assets, market neutral strategists, making money dollars on dollars, Bitcoin on Bitcoin, ETH on ETH. Team is almost 50 people. We do all of TVO deals, algo trading, arbitrage, pretty much all the risky stuff you can imagine we do this, right? So that's what we do.
Nice. I'm John Campagna. I'm the co-founder and chief operating officer of Nexyst Digital. I also going to age myself like Vadim, 15 years in traditional finance. I got into crypto around 2014 personally, and professionally in 2019. I was a venture partner at CoinFund and then launched Nexyst Digital in 2023. We are a digital asset hedge fund and structured product platform. We focus on Bitcoin structured products and yield. It's leaning a lot more that way over the last few years, but we can get into that as the panel goes on.
Hi, everybody. I'm Kevin. I'm the co-founder and CEO of Saturn. So I don't have 15 years in TradFi, but I graduated from Penn, and then I went to Artemis as the lead analyst there. And then last year, I started Saturn. Essentially, we are RWA yield and stablecoin protocol. And we bridge MicroStrategy's preferred equity digital credit back on chain. So we offer this actually really crypto native yield in TradFi and bridging the world between the off-chain TradFi markets and the on-chain markets.
Great, and that's a good segue. So let's really level set here. So when we're talking about yield in crypto and in Bitcoin today, are we actually talking about one thing, or are there fundamentally different categories of return? Whoever, John, would you like to take it?
I'll hop in. I think when it comes to Bitcoin, it doesn't have, you've heard the argument, it doesn't have native yield. I am friends with one of the largest Bitcoin miners in the world, and he claims that that's baloney because there's a thing called hash rate. Hash rate is the computing power needed by a miner or the energy to create more Bitcoin. So theoretically, the hash rate is itself native yield. I've heard the argument that funding arbitrage, so just the structural basis of how digital assets are traded, perps versus spot, there is a carry trade in there. That's actually passive, so that's theoretically also native. I'm sure that we're going to hear an argument that digital credit, this new evolving space, has native yield through its financial, well, I don't want to say financial engineering. I don't want to take that from you yet. But yeah, there's ways to trade for yield. So think options overlay, yield enhancement strategies. So yield is how you kind of want to define it, especially in a kind of an emerging technology like Bitcoin. The way we define it at Nexyst Digital is we believe that true yield is something that is passively earned. So for us, it's through a high-frequency trading funding arbitrage strategy that 5 years ago was making 40% unlevered, doing nothing, and today is actually slightly negative. But I'll pass it on to my co-panelists to hear their takes.
A few comments on my side, right? So there is no risk-free. This is very difficult to make money on Bitcoin, right, in a risk-free manner. There are different ways to, the right word is clearly either leverage or credit or other things, right? If you slice it how we think about it, the first one is, what can we do with Bitcoin, right? First of all, we can argue about it. I had a long argument with one of my clients in the morning. I said, Bitcoin is one of the most liquid assets on the planet, right? You trade 24/7, right? Can sell at any time. And he's like, well, can I sell 10 billion in a clip? I'm like, well, you can't sell 10 billion of like a stock on a clip on Sunday, right? So it's liquid, extremely liquid. You can use it as collateral, right? So I better take Bitcoin as a collateral than a house or apartment in Miami, right? Frankly. So if I'm doing loans. So lending against Bitcoin is a normal business. If you can use something as a collateral, it can generate yield, right? So this is one of the arguments to say you can generate some synthetic loans and generate yield on top, make money. This is first use case, so see that at Maple Finance has been doing it like for the past 5 years, basically, right? Second block in terms of generating extra yield on Bitcoin is always what we do. You can either use it as a collateral for margining, right? You don't have to do synthetic borrow, right? You can use it for margining and generate extra yield like you guys do and other things, right? This is a cleaner version, so you don't have to pay for the loan. Third option, you can borrow stables against it. Cost of borrow right now in the market, if you do OTC, 6 to 8% in dollars. If you do it on chain through Maple, 3 to 6, right? If you can make more than 6%, like 10, 15, sure. You're making extra yield on top of this. And you can do HFT trading, you can do option sell and everything else. This is risky, it's non-delta neutral, there is negative gamma in this type of strategies, right? So, but it's all sophisticated structures, but short answer, there is no natural yield, you cannot rent it, there is no staking yield. So that's why on the one hand it's good, on the other hand it's bad, right? So that's why you have to be smart how you think about it. So.
Yeah, so from my side, I think we essentially tokenize MicroStrategy's preferred equity, and we lend money to them. So what STRC or these digital credit is any credit that's backed by Bitcoin. And MicroStrategy's mandate is to borrow money and buy Bitcoin. And what this digital credit product is, essentially you're lending to that. And how you can think about it is that you give them money, they give you the first 10% of Bitcoin's cargo in returns each year, and then they kind of take the rest. And in doing so, they turn Bitcoin into this powerful engine for yield. So it's USD denominated. And once you create this double-digit USD denominated yield, you can actually also create Bitcoin yield because many investors kind of borrow against their Bitcoin at 3 to 4% cost of capital, both on-chain and off-chain. And then they capture the spread between the yield that strategy pays and the cost of capital on-chain. So I think it's very unique because what strategy has essentially done is stripped away the volatility of Bitcoin and given the first 10% of Bitcoin's returns to all investors.
That's really interesting. How long, we hear strategy in the news, they are offering quite I would say a high yielding kind of coupon there, and it's gotten quite a bit of attention, but how long can that last?
Yeah, so we get asked this question quite a bit. And I think essentially why is there high yield? I think it's because TradFi does not know how to price Bitcoin as a collateral. Because when you really understand Stretch or the preferred equities that strategy have issued, the LTV is 25%, right? It's 4 times, like the over-collateralized ratio is 4x. And from the crypto people, if you can find something, a credit that pays that's over-collateralized by 4 times, it should be very safe. But in reality, in TradFi, because if you look at the S&P report of MicroStrategy, they essentially view Bitcoin as negative capital. So I think the fundamental alpha, or why the yields are so high, is because there's a mispriced here. And why, for example, like protocols like Saturn and Apex have scaled quite rapidly is because you are bringing an instrument that is priced poorly in TradFi to the on-chain world, in which the on-chain and the crypto world really understands and appreciates Bitcoin as a collateral asset. So I think STRC Stretch today is paying 11.5% yield. The cost, the US Treasury yield is like 3%. I think the spread probably won't last this wide for that long, but I think there's still going to be like a structural spread there. Like maybe it's not going to be 11.5%, maybe it'll be 8%. But how long will this last until TradFi really understands Bitcoin as a collateral is what we would say.
Well, let me add something. I'm going to talk Kevin's book for him. If anyone else was there last week, it was fascinating. So I was at the Bitcoin 2026 conference in Las Vegas, and Michael Saylor spoke for an hour on Stretch. And he had one slide that's sticking with me that he should use at Saturn to talk about this. He held up Stretch at 11.5%. It's 4x over collateralization, MicroStrategy's ability to pay that dividend regardless of anything else for about, I think it's 2 years right now. And then he held it up against municipal bonds from Chicago, New York, LA, and somewhere else. And they were all at like 14 to 16%. They were under collateralized. He actually had it showed that they can't, as of this moment, pay these actual yields. They are, but they're just borrowing to pay more. And his entire argument was that, in theory, if you had blanked out what these assets were, who the issuers were, everyone would choose Stretch. And his argument is that it can last for a long time. I am not stating that, but I thought it was very interesting when put in those terms.
Not financial advice.
Not financial advice.
Proper disclaimer.
Yeah.
Great. We are talking about yields right now. What is there isn't really a risk-free rate, as you've mentioned, in the space, but what is the base kind of yield that you are referring to as a benchmark for folks getting into Bitcoin in the crypto space? Obviously, understanding that it does scale up with the more risk you take, but what would be the closest thing to a risk-free rate right now in Bitcoin?
I can comment on this, right? When we speak to people, when they invest in Bitcoin with us, so we manage a substantial portion of Bitcoin in our Bitcoin share class, and we have primarily institutional banks investing with us. It's a blend of US, Europe, and the idea is very simple. If you can make us 5 to 10% in Bitcoin, this is amazing. Well, I tell them, listen, guys, 10% in Bitcoin, it's not a joke, right?
Yeah,
well, we historically did, I think, around 20 net over the past 5 years. But look, environment is different. To make 10 in Bitcoin, I'll give you a simple example. So you put $10 million in Bitcoin. I would probably borrow $5 million of cash against it, right? So LTV is simply very conservative, 0.5. Then in order to make 10% on Bitcoin, I got to make, first of all, divided by half. So plus I have to borrow at 6. So I got to make 26% net, dollars on dollars, to make 10% in Bitcoin, plus fees and everything else. So it's 30% net returns. Madness. It does not exist, period, right? So I tell them, listen, 3 to 7% in Bitcoin, that's your natural rate. If someone is promising you 10, they're taking excessive risk, or they're doing bull selling, right? Option selling. They make you 2% a month or 1% a month, and then they lose 20, right? This is the narrative. So from their perspective, they can lend out Bitcoin about 2-3%, right? So this is becomes your risk-free rate. But you lend it out to Galaxy, Hidden Road, Ripple Prime, guys like this, right? It's even lower right now, right? There is also lending that some hedge funds do, right? So just put it as a margin, but would borrow it easily, right? And top up our margins, right, on centralized exchanges. This is kind of becoming basically 1 to 2% is risk-free in this environment, right? So people just top it up, and brokers use it as collateral. But you take counterparty risk on a broker. Usually big names are fine, right? Big market makers, hedge funds are fine, simply because leverage in the system is extremely low, right? Most of the hedge funds are massively under-levered, right? So massively, right? Because there's no leverage. I cannot do 10x leverage on my positions. I wish I could, but we can't. So that's why this is giving you an indication, 2-3% below this, people just say we're not interested, it's too low, right? Once you go to 5, 6, 7, it's already risky trades, they understand it. If someone is making you 10 plus, they're taking all of the directional risk. That's it. So.
I totally agree with the number that Vadim's saying. It's 3 to 6, and that's come down. Well, that's come from years of us really watching how the market has moved, what true yield looks like, and how you generate this level in a risk-adjusted fashion, and then client expectations. The conversations when we first launched this 3 years ago, clients were looking for 15% on Bitcoin returns, 20% Bitcoin on Bitcoin returns. That number has changed dramatically. It's now 3 to 6%. Consistently with principal protection, if you can create that product, you will have massive, massive demand.
Is that still Bitcoin on Bitcoin?
That is Bitcoin on Bitcoin.
Bitcoin on Bitcoin.
Yeah, so for a product like us, we're stablecoin denominated, so not BTC on BTC. So for us, I think our benchmark rate that we try to hit is either Athena or Aave, which is around 3 to 4% right now. And I think the pitch that Saturn is really trying to push is that we believe that the hurdle rate on chain should be Stretch. We view Stretch as the money market fund, or kind of like the T-bills of Bitcoin, and that it's a 4x over collateralized, 11% paying, pretty very decently stable product. And until Stretch becomes kind of this hurdle rate on chain, at least where we're seeing the demand is on chain, is the capital is just going to flow into this area.
We're in trouble, Vadim.
Right?
We're in trouble. He's saying it's
I know.
11.5%.
11.5% is quite attractive,
I mean,
right? Effectively, you
it's
are
stable and stable.
Stable
though.
and stable.
I mean, like, we have actually had a lot of clients that wants 3 to 4%, and we can't offer that. So
Yep.
I think there's still a place for you guys, right?
You should do a trade. You should borrow against Bitcoin and put it in 11% yield, right? So and lock it for 2 years. Imagine theory, right? Everyone's happy.
So I guess here's the other kind of question to this, is how much capacity is there as institutional capital continues to enter, right? Are we going to see yields kind of go down? Maybe Stretch is a little bit of a different kind of animal, but are we going to see more of these new opportunities emerge to replace them?
I mean, 2 months ago, if you asked me that, I said that they have come down and they're going to stay down. And now I'm not betting against innovation by any stretch of the imagination, but it's more from a risk-adjusted way of viewing how to generate yield on a non-yield-bearing asset, right? So I was under the impression they were going to compress and settle around this 3 to 5% kind of, with not taking undue risk level.
What would you qualify as undue risk here?
Yeah, I say passively. So again, this goes back to funding arb, right? You stay delta
Yep.
neutral. You're not exposed directionally. Yes, there's some, as Vadim would know, there's some counterparty risk obviously involved. Again, hash rate financing, if anyone is familiar with that, you just provide Bitcoin to a miner. You pre-fund a miner's output, and then you receive daily P&I back in Bitcoin. That yields around 8%. But again, now you're taking miner risk. So those, in my view, those are relatively passive and relatively a decent risk-adjusted return. But then again, like I said 2 months ago, that all kind of made me rethink once I saw Strategy's new thing. Because I think, correct me if I'm wrong, it went from zero tokenized STRC in DeFi to 350 million in like a month. And it's on pace. The pace is insane. It's going to be like $5 billion in the next 12 months. And that's going to be a real number, a hurdle rate that's sitting out there for people. So, yeah, I think.
Yeah, so I think so there's 2 players right now. There's Saturn and Apex. We launched a month ago, and then we hit 150 million in a month. Our competitor, Apex, hit, I think, 250 in 2 months. And then some more stats on Stretch. Stretch started late July of last year at 2.7 billion. Actually, the first IPO was like 600 million, and then it got like oversubbed to like 2.7 billion. And then during a bear market, Stretch increased from 2.7 billion to 8.5 billion. So in 6 months, it almost like 3 times. So imagine this in a bull market where Bitcoin is going up. We think that like STRC is probably going to 10x in a bull market.
I can add a couple of comments on my side, how we see it. Well, first of all, we do see expansion of the universe overall, right? So I think current yields are already very low, right? So we're very limited in terms of what you can do with Bitcoin. Basis is very low, very competitive, right? So, and it's just a dollar environment when all altcoins go down, crypto is selling off, people concerned about hacks, you can't make money, right? So volumes are much lower. So if you look at the data tells you that based on the data, we are post-FTX environment right now, right? So basically, based on the volumes, valuations, complete disaster. On the other hand, your fundamentals like laws, right, in the US, legislations about stable coins, all the brokers in the US are getting the crypto, completely different world, tokenization of assets. Now you trade oil, commodities, everything else. So this is a very, like, I would say, different picture, right? So it's extremely fundamentally very positive. Clearly, all the small altcoins that generate zero revenue, and that was just a hype token, there was zero, like, I don't know, $1,000 revenue a month on chain revenue, but they shouldn't exist, right? They should be zero. Why would they with $5 billion? I don't know. It's all got repriced. So this wiped out a lot of yield bases, everything else. At the same time, now what we see is, we went to iConnections a few months ago here, also here in Miami, right? And you have all the biggest names, like big brokers coming into crypto. They're launching trading desks. Like they bring people from FileConnect, Galaxy, launching separate divisions just for crypto. So all tokenized assets will be here. Number two, they will all use Bitcoin as collateral very actively. Currently, margin requirements for Bitcoin are still bad, right, on CME and everywhere else. Yeah. They will expand it, right? Once you have guys like Cantor, Clear Street actively using BTC with high OTVs, you have an opportunity to use it and do some other trading, invest anywhere else you want, right? It gives you an opportunity to make more money on Bitcoin. So I think universe is expanding, it's very positive. Brokers here getting more capital in. So now you're not that constrained as you used to be by generating yield on your Bitcoin as a collateral. So I think we're pretty positive, to be frank, and look at Hyperliquid. Now we trade oil, S&P. S&P futures didn't exist on Hyperliquid 3 months ago. Now they're $500 million in open interest. Go ahead, arbitrage it out, right? So, so extra yield, and you have more assets like this. So I think it's pretty positive in my opinion. So.
Yeah, indeed, right? And I think the last few months have seen, especially folks like Hyperliquid, and it seems almost like a reaction to meme coins, this move into RWA. I would say some people in the crypto space who have been in this for a long time, depends how you look at it. Some people are frustrated that it's still moving too slow. And why do you think, what is preventing these big guys from getting in, like the Cantors of the world?
Good question. When you speak to them, they're all doing it baby steps, right? So obviously it's about custody, compliance, regulations. So for example, when you speak to staking operators, right? So the biggest names like P2P, Figment, and a few others, right? So they would, frankly, like some of them were worried in private conversations because in the past, staking was a broker-dealer business here, right? Yeah. They're like, what the hell, right? So now it's clear it's not, but it took the US, like what, 4 years to came to this conclusion, right? So now they're like all full way building the businesses, hiring more people in New York. So we see it in the back end happening, right? So I think the US got lagged so much. I don't know why, right? So I think they all took a decision to go to crypto about mid last year. Now all of them, by half a year gone, more people came in, and now we have a big sell-off at the same time. Right, so short answer, it's coming from basically from the leadership here primarily, so in my opinion.
I mean, I think the first step to Vadim's point was just getting exposure, and I think the ETF solved that a lot. You heard Bitwise talking about it, I think Jonathan was talking about it. That is the initial first baby step, is how do we get exposed, how do we get our clients exposed, and all that. I think staking, and it's all about counterparty risk and how they view that. And the digital asset community, we haven't done a great job of showing that we've grown up from time to time with all these hacks and all these kind of less than institutional kind of quality ways to go about thinking of yield generation. But I do think what it's put a focus on and who's doing things correctly in the industry, which is, I know Vadim has benefited from that. We're trying to benefit from that. There are people who are standing out and firms that are standing out because they think about things from an institutional way. And I think that's actually getting more traction than the overall numbers would actually justify.
Yeah, so from my side, I look more at like the credit RWA, and I think Stretch is actually a representation of a real world asset. And I think there's 3 problems that I think we see in why Stretch works. Well, first is when you bridge between the off-chain world and the on-chain world, you need the liquidity to kind of go on and off ramp, right? When users buy it on ramp, you need to be able to buy it, and when users kind of unstake it or redeems it, you need like a buyer on the other end, or like the off-chain world to actually to be there. So there's this like gap kind of between like liquidity. So that's number 1. Number 2 is like you need to find, I think, standardized credit products that can really scale. So I think Stretch is one example. I think the GPU loans is like another example. And then third, I think from an yield perspective, it also needs to be decently high. I think most of DeFi today, at least how we see it, is there's like more and more institutions coming in, but retail still, like Asia retail is still a big part of it. So like you need higher yield is also like a factor here. So if you're offering like 5% or 6%, it's just not that interesting.
Yeah, indeed. Well, I want to leave some time for questions from the room. Any Q&A here? Yep. I think somebody should. Is there a microphone? There's a question in the room.
Thank you. My name is Chris Dora. I am principal at DEC Holding, and we advise institutional allocators on governance and capital architecture across digital yield strategies. My question today, I have one specifically. From an institutional CIO perspective, how are BTC yield strategies being classified internally? Enhancement to core BTC exposure, separate income sleeve, or alternative credit analog?
From a governance, I defer everything to Vadim.
So let's say I think the right answer to answer your question is the following. We have a few banks investing in us and a few US ETF providers deploying capital with us. From their perspective, it's basically the core strategy is directional Bitcoin. If you can enhance the yield, it will be in the same sleeve. It's not credit, obviously, right? It's effectively extra yield on the top of the assets, and they sell it to a client this way, saying like, we'll run a fund of funds, we're charging you fees, but we'll select a manager, we'll make you extra 5% on the top of your assets, right? So that has been working well, I would say, mostly London, Europe, right? US, baby steps with digital asset treasuries and everything else. So from their perspective, they look at this. It has to be fully regulated product, right? Institutional, with insurance, with minimum risk, right? Because the whole goal is like must have like zero drawdowns, everything else. Second option, they can do it themselves. They can sell some options, for example, on this as well. We have one sovereign nation invested in us, and they do so. They trade options themselves at the name of the central bank of the country, basically, right? So they can sell vol. That's fine, right? So that's how they think about it. It's a yield-enhancing directional strategy for the bucket of crypto. That's typically how they do this.
Hey everyone, my name is Abdiel. I was but I had a quick question on the hash rate market.
Yeah.
How big is that really? And is your focus kind of thinking, hey, what is this, mining company, like what are they using this Bitcoin for? Because what you've seen kind of like through kind of sell-side analysis is that most of these mining companies really are just taking this Bitcoin and selling it to gain more liquidity. So any thoughts on that?
Yeah, well, there's a company called Luxor. They are essentially the exchange for trading hash rate. So hash rate itself just trades natively. That market's growing about 4x year over year, and it started to slow down. And the interesting reason for it, it's actually makes a ton of sense, is these private equity firms and some of these AI think of like these HPC companies have come in and started buying these data centers that used to be Bitcoin miners. And I have a friend who says every data center is built on the bones of a Bitcoin miner because it's the technology or the theory is the same, right? You have power contracts. You are trying to cool, like, right? You're mining for this energy, and there's been a ton. CoreWeave, I think CleanSpark just announced they're offloading 80% of their mining to focus on AI. That will have a huge impact on hash rate, which I think the yield of hash rate is going to go up. And the reason for that is you're going to see it start to go to new miners, potentially more risky miners, not the same credit profiles of a CleanSpark, of a Marathon. I do think that industry is going to see some volatility, which I think would result in higher yields.
So when you were saying that you're really investing in the hash rate, you're not necessarily lending your Bitcoin directly to, a Marathon, for example.
No, you are, and you get paid back with what's called hash rate. It's just another word. It's Bitcoin. So the way it works is you pre-fund their production,
Correct, yeah.
and because you can model all this via hash rate, you get it back daily. You get part of everything back daily. It's pretty cool. Yeah.
Thank you, panelists. Thank you, everybody.
Thank you
Please find us. We're here walking around if you have any further questions.
Thank you.
Thank you.